Hey everybody, hope everyone's doing well and had a good day. This is the Emini review for Friday, June 21st, 2024. And because it's Friday, we'll go ahead and look at the weekly chart first. And I mentioned yesterday, I believe, that we had this rally, 3-bar or 4-bar micro channel for the bulls. And the bears were hoping to put as big a tail on top of the weekly chart bar as they could. And that's what they did. They were able to get the week to close below its midpoint. And if you look, I had this here. Here's the midpoint, the red line. And we closed just a bit below it. So the bears can say, okay, we got the close below the midpoint. This is technically a sell reversal bar. There was more selling on this bar than buying. And the selling came in the latter portion of the bar. So it's good for the bears. The context is still bad. Some bears might argue it's a low 2 short, low 1 below here, then a big low 2. But the reality is this is tight enough. The first reversal down will probably be minor and will likely find buyers below. It's also still a bull close for the signal bar, 3 consecutive bull bars. So the odds are this is going to fail. It is a big low 2. Other traders will call it a low 1. This breakout might have been big enough, strong enough to reset that leg counting or bar counting counter. So this was a low 1 that failed. This is another low 1, probably will fail. And then on the daily chart, we had the outside day yesterday, Thursday. And I mention it all the time on the intraday 5-minute chart. Outside bars are trading range bars. And what that means is it functions like any other trading range. You expect sellers above and buyers below. Because the bar closed with such a big tail, not that it closed in the middle of the bar, but it didn't close near the low. So because of that, I thought today had an increased chance of being an inside day. But again, with what I just said, the odds were if we went below yesterday's low or above yesterday's high, there would likely be sellers above and buyers below. So with that, we'll go ahead and look at the 5-minute chart today. First thing I'll do, draw yesterday's low. So we gapped down on the open, and just look at yesterday. Even though it was a big outside down day, we had this big sell-off. The reality is this was a bear trading range day. We went sideways for almost 3 hours on the open, and then we went sideways for about 3 hours into the close. So it's mostly sideways price action. And so that's my expectation coming into the day is more sideways. We're in a trading range. This might be the high of the range. This might be the low. And again, we're expecting support below the low of yesterday. So bar 1 gap down. So we have a gap down from the close of yesterday to the open of today. And today bar 1's a bull reversal bar. Closing on its high, good for the bulls, and not the worst context. Might be 3 pushes down, 1, 2, 3, and then a decent reversal bar. Also 2 legs down here, leg 1, pause, and then leg 2 with the gap down. One problem the bulls have is that they didn't trigger the buy above bar 80. What that means is this is the first reversal attempt since bar 78 down. It's a micro channel. No bar traded above the high of the prior bar since bar 78. So it's a problem for buying above bar 1. The odds are the buyers will come in below bar 1, but also the low of bar 1 is so close to support the prior day's low that the buyers may wait until the market gets there to start buying. Because the market's in the middle of a trading range here and forcing you, if you were to buy above bar 1, you'd be forced to buy on a stop in the middle of a trading range, which is never ideal. there's probably more sellers above bar 1. And then bar 2, we had a bear bar. We triggered the buy above bar 1 and had a disappointing entry bar for stop order bulls. Bar 2 is a bear bar, but it's a low one sell signal bar at the bottom of a trading range. There might be some more to the downside. The probability that bar 1 remains the low of the day is about 20%. And you have the support below, bar 1 low and yesterday's low. So we're probably going lower. But it is a low one at the bottom of a trading range, so some traders will buy. And then bar 3, we got vacuumed down to a new low. Bar 3 is a good bar, and it did break out below yesterday's low. That's good, but only by a small distance. The actual breakout is from the red line to the close of the bar. So pretty big bar, but maybe only 10%, 15% of the bar is actually breaking out. So the bears, they still need follow through. And the more they can get below yesterday's low, the better. The problem is we have buyers below bar 1 scaling in lower. This price becomes resistance. Bulls who bought below bar 1, disappointed with bar 3. If the market gets back here, probably going to be sellers. And then bar 4, we immediately reversed up. So bear breakout to a new low, bar 3. No follow through on bar 4. And bar 4 was actually a strong bull reversal bar. Now we have a second entry buy, the first one above bar 1, second one above bar 4. Some traders will buy above bar 4, maybe 3 legs down here, 1, 2, 3. Low in a trading range, failing to break out, strong bull signal bar. But think about what just happened below bar 1. Bulls got trapped, scaled in lower. This price is expected to be resistance. And that's why bar 5, we sold. Bar 5 is a fairly impressive looking bear bar, but the context is bad. It's basically completely overlapping bar 4. And think about the leg count. Overall, it might be 2 big legs down, 1, pull back, 2, and then it's maybe 3, maybe 4 legs down, 1, 2, maybe 3. Bar 4 is a strong bull bar. The odds are there are buyers below bar 4 and buyers below yesterday's low, which we are below. And just look at the overlap today too. Is this a strong looking bear breakout? How many strong bear breakouts have 2 good looking bull reversal bars closing near their high? Not many. And then you can see bar 6 reversed up again. So bar 6 is an inside bar, so it reduces the probability for breakouts because inside bars are trading range bars. And just look to the left. It's a tight trading range over the past 4 bars. But if you think about the overall context, I normally would say with inside bars, there are probably sellers above and buyers below. But in this case, I would only look to buy below. And the context is actually fairly good for traders to maybe buy above bar 6 or buy the close. The reason for that is we have 2 big legs down, so maybe big leg down here, deep pullback, then a second leg which subdivided into 2 smaller legs. And then overall, we're in a trading range. And if we're overall in a trading range, ask yourself, where are we in this range? Are we in the upper third, middle third, or lower third? I like drawing this sometimes, and it gives you a visual of the lower, middle, and upper third. I know these lines are actually faint. I'll see if I can make them darker, just so I can show the point I'm making, and that is trading ranges. It's often good to look at them in thirds. Look to sell in the upper third, take profits in the middle. Look to buy in the lower third, take profits in the middle. So if you had to do anything here, I would only look to buy. Until the bears can prove this is a strong breakout, we start getting closes, consecutive bear bars and closes way down here. But until we get that, you have to assume 80% of breakouts will fail. This is no exception. A couple attempts down, the bears are failing. Every time we get a decent bear bar, it's followed by a strong bull bar. So that's a warning that we may have to test higher and we're running out of sellers. Also the fact that it could be 3 legs down, and the reason I mentioned leg count, maybe 2 big legs down, maybe 1, 2, 3, not ideal, maybe another one here. The point is, you have bears selling up here, then we have sell climax, a third consecutive sell climax. You have exhausted bears. You have bears who sold up here, taking profits, and they're going to be unwilling to sell after 3 consecutive sell climaxes, maybe 2 big legs down, low in a trading range. The bears know we're low in a trading range. They want to sell high. And the bulls know that, and they're going to look to start buying as well. So you have the combination of strong bulls buying at the bottom of a trading range and strong bears taking profits, buying back shorts at the bottom of a trading range. The market's probably going to go higher. Bar 7, we have a bull breakout, but it failed immediately, and that's common because it's an inside bar. So we broke out, pulled back immediately. But the bar still closed with a bull body. And with everything I'm saying with the context, and then you see bar 7, consecutive bull bodies, it's a low 1 short at the bottom of a trading range. What do I say about low 1s, low in a trading range? They're not continuation setups. You don't sell them. If anything, traders are buying below bar 7. It's also common to see these types of setups not get triggered, or in other words, the limit order doesn't get triggered, and traders instead buy the close of bar 7. But I suspect there are buyers below 7 scaling in lower, maybe buyers on the close. And then look what happened on bar 8. These lows are identical, 55.27. The market, we opened here, sold off to the low, tested the low price. Anybody who had a limit order, either at the low of the bar or 1 tick below, may not have been filled. We know the limit orders below the bar did not get filled. And it's often the market has to go 1 tick beyond your limit order to fill you. So if you did try to buy the low of bar 7, you may not have been filled because the market tested that price to the tick rather than going 1 tick below it. The reason that is significant is because if bulls are trying to get long here and they're not getting filled, eventually they start to feel a sense of urgency. We know we're low in a trading range. We're trying to buy below a bar. We're not getting filled. Eventually they start buying the market. So bar 8, we reversed up. We have a bull inside bar, but it's similar to bar 6. It's an inside bar, but I would not look to sell above it. We're still low in the trading range. We're getting consecutive bull bars after a couple of failed attempts down by the bears. If anything, traders are looking to buy below bar 8. And then bar 9, that's the type of bar that bar 8 could have been, where I'm talking about traders will buy below, but because of the context, they might just buy the close, and that's what happened on bar 9. Traders bought the close of bar 8. They saw their limit orders did not get filled below here. There's a sense of urgency. Bar 8 closed, and everybody bought the market. So bar 9 is racing up. There's a couple problems with bar 9 for the bulls. The first problem that I see is that it might be 2 legs up. Bar 6 and 7, we went up, then a big tail on bar 7, and then we went down on 8. That's an implied pullback on a lower time frame. So leg 1, pullback, leg 2. 2 legs up at the top of a trading range. Now, this whole thing might be the trading range, that is true, but you do have bulls who bought the close of bar 1, and those bulls got trapped on bars 2 and 3. What they do is they scale in lower, and when the market retests their entry price, you expect those bulls to be disappointed. If you're a bull and you bought bar 1, you buy the close, and this is what you get, what are you going to do if the market comes back to your entry price? You're probably going to take your break-even trade and move on, look for something else. The other problem I have with bar 9 is it's climactic. Why are we getting the strongest bull bar of all the 4 past bull bars on the 4th bar? Plus bar 7 and 8, lots of overlap. So again, probably leg 1, pullback, leg 2. And then bar 9 is just below the moving average, where there are probably sellers waiting. So all of that leads me to believe we'll at least pause here and find sellers. Bar 10, we have a doji. So the market's stalling. It's a pause bar. After a climactic bar, you do expect 1 to 3 bars sideways. And the reality is, this is actually all 1 leg up for the bulls. This is a micro channel since bar 4. you'll notice no bar has a low below the low of the prior bar since bar 4 with bar 3. So that's a micro channel for 6 or 7 bars. And that increases the probability that there will be buyers below. The first pullback will be minor. But the problem with that, so why not just buy below bar 10 and go for a second leg up? The context is the problem. The market's in a trading range. When the market's in a trading range and gets a breakout like this breakout here, plus the breakout has problems, it might be 2 legs on a smaller time frame, overlapping bars. But whenever you have a breakout in a trading range, the expectation is a deep pullback before a delayed second leg. So rather than buy up here, maybe at the top of this trading range, traders might rather look to buy a 50% pullback. That's a really common level. And I'll draw that because I'm interested to see what happens at that level. So that would be this line. I can delete this one and I'll just put a label for low of yesterday. So it's a weak sell signal bar. It's a micro channel. The odds are there are buyers below bar 10, but no one wants to buy this high in this trading range. Instead, traders might wait to buy down here, maybe even lower. So there's room to the downside, but I do think the downside is limited, and I would not sell below bar 10. Bar 11, almost outside down. The market rallied and then sold off. Strong looking bear bar, but the context is still pretty bad. It's a big enough surprise that it will probably lead to a second leg. You did have bulls buying below bar 10, getting trapped on bar 11. And what are they going to do on a retest? That makes the low of bar 10 resistance. If we retest that price, we're expecting sellers. So strong enough for a second leg down, but it's minor. Compare bar 11 or even bars 10 and 11 to this breakout. Obviously this one has more bars. It's a micro channel all the way from bar 4, covered a bigger distance. And then this is just 2 bars, and one of them's a doji, and it's much smaller. We're still expecting a second leg up after this rally, but we are expecting a deep pullback as well. 12 disappointing for the bears, and it pulled back. It went above the low of bar 10, so bulls who bought scaled in lower. They were able to avoid a loss. That's a problem for the bears. The bears wanted this to just keep selling off so that the bulls who bought here got trapped further and further. And eventually those bulls have to liquidate. They have to be forced to sell out of their positions. That's why trap traders is so important. On this breakout, it's not as strong as it could be. It's an inside bar from bar 6, but you did have some bears selling the close of bar 5, front running the breakout, and they're trapped. So if we do get back down to this price, we'll probably find support, more buyers than sellers. 12 is a high 1 buy setup, but it's just below the moving average, high in a trading range. High 1s in trading ranges are sell setups. Plus, there's a tail on the bar, probably more sellers above. You also have the moving average resistance. Instead, everybody sold the close. So instead of going above 12, everybody just sold the market. And bar 13 is the second leg down. Here, down on 11. Pause bar, it's an inside bar, so not a technical pullback because we did not go above the high of bar 11, but it's an implied pullback. There's a pullback on a smaller time frame. So leg 1, pullback, leg 2, and look where leg 2 is ending, right at that 50% level. So for a couple of reasons, we're expecting actually more buyers on the close of bar 13 than sellers. And then look at bar 14. It's not the strongest bull bar in the world, of course. It closed almost on its low. It's really a doji, but it has a big tail on top. And what that tail represents, there's a couple of things. The first thing it did is it traded above bar 13. And when you think about this on a smaller time frame, we had 2 legs down, 1, 2. Then we rallied again and sold off again, so it might be 3 legs down. And what bar 14 is on a smaller time frame is a trendline break. So we have a bear channel, but expected to be a bull flag. Trendline break, retest of the low, we're expecting buyers below 14 or even on the close of 14. But then 15 disappointed the bulls. The bulls were hoping for a big bar like 6 or 9. Instead, we got a weak doji. But you got to think about the opposite side of the trade. What are the bears thinking right now? We don't have trapped bulls. Bulls who bought below 10, able to avoid a loss. Bulls who bought below 12, they made money. This is not looking good for the bears. We still have trapped bears below, bears who sold here. We're also testing a breakout point, like the bar 5 high. It's not perfect. Bar 11 actually reached that breakout point here. We're trying to break below it again and going sideways. Now we have an inside bar, bar 15. After 2 legs down, maybe even 3. Low 1 at support, the 50% pullback, the market's stalling. Probably more buyers below 15. And then you can see 16. Instead of going below, everybody bought the close. It's really common. I see that all the time in trading ranges. And it makes me wonder. Traders, they're looking to buy below 15. They know it's a bad sell setup. A bad stop order trade is a good limit order trade. So there's limit orders waiting below 15. But at some point, they have to realize their market or their limit orders are not getting triggered, and they have to buy with a market order as the bar is going up. 16 is a good bar for the bulls. It's a big bar. It's undoing all of this to the left, but it's still at the top of a trading range. And it might be a second leg trap, leg 1, pullback, leg 2, but the market likes to do things in a more symmetrical way. So maybe this is leg 1, and leg 2 comes up here. The thing about the day structure, the odds are this is not going to be the entire day's range. It would be incredibly small. And we can just look really quickly. The range is less than 20 points. And over here, this is the daily chart. The range, 62 points, 20 points. So we have had a 20-point day. 70, 45, 45, 75. It would be unusual for the market to stay in this range and for us to expect we've seen the high and the low of the day. And again, when you think about the actual structure of the day, the bears tried to break out below yesterday's low, and they failed. They tried twice, once on bar 3, failed in a big way. Again, on bar 5, but still within the range of bar 4, failed in a big way, all the way up here. When the market tries to do something twice and fails, it often tries to do the opposite. So we've tried going down twice. Now the bulls might try to go up. And again, this might be the top of the trading range. So there is some resistance above. And for now, I'll just keep it like that. So 16, we're probably going higher, but we are expecting resistance. Just look to the left. Every time we've been at that price level today, sellers. We get there again, sellers. Probably going to be more sellers on 16. It is an overall trading range. We're high in the range. 17, it's a bear bar. The bulls hoping it's a breakout pullback. There's still an open gap. There's a micro gap from the high of 15 to the low of 17. There's a space between these bars. What that means is bears who sold above 15, they're trapped on 16. They haven't had a chance to get out at break even yet on 17. So the bulls hoping it's a breakout pullback and then continuation. The bears, they're hoping we maybe have a double top. Here's 1, and then 2. We sell below 17. But look at 17 compared to bar 16. 16, it's a really strong bull bar. It crossed the moving average. And I always have that day structure argument sort of in the background of my mind. The bears already tried twice, and this is a fairly weak sell setup. Pretty decent rally here, probably expecting more to the upside. And the selling pressure isn't all that strong. Decent bear bar, but then no follow through. Decent bear bar, no follow through. So there actually might be more buyers below 17. And then 18, we tested that breakout point, so the micro gap, it didn't get closed, but we did touch it. So there's actually still a gap. And there's even a gap from the open of bar 13 to the close of 17. There's a space between these two prices. So on the line chart, there's actually a gap. The line chart plots closes. Now, if you're a bear and you sold 17, 18 is a problem for you. And you also have the bar 18 stat, which is that I actually don't know the exact number. It's something like 80 or 90% of the time. It's some high number. 80 or 90% of the time, by the close of bar 18, you've seen either the high or the low of the day. And what's more likely? Have we seen the high or the low of the day at this point? Of course, it's more likely we've seen the low. Maybe 60% chance. If we're high in a trading range, we start to reverse down and we have increasing selling pressure. Maybe this becomes 50%, 40%, 30%. But for now, probably a 60% chance we've seen the low. The bears are going to argue we have 3 legs up, maybe some sort of wedge here, hoping it's a wedge in the top of a trading range. But again, look at the selling pressure compared to the buying pressure. It's easier to make money as a bull than a bear. We tested that 50% and rallied, so I'm going to delete that. And then with bar 18, we went outside up. So you had bears selling below. They got trapped immediately, and we're probably going to go higher. 19 bull breakout, but pulled back immediately. Finding some resistance at the 60 EMA, that's the dotted line, and then also prices to the left. There's a lot of prices to the left. You don't know which one exactly is being tested, but there's a cluster of resistance here. The market broke below, so bulls who were long, they got trapped, and then we're going up for a couple of legs. It's not surprising to see the market start to stall in this area. But if you're a bear and you're looking to sell, can you sell below bar 19? I would not. Even though it's a low 2, maybe a nested low 2. So here's a leg 1 and a low 1, pull back. Leg 2, low 2, and then low 1 here, low 2 here. It's all true, but the market is in a bull channel. And whenever you see a low 1 or a low 2 setup in a bull channel, it's actually a buy setup below. You have a bull bar 18, bull close 19, and a good bull bar 16, and a relatively small bar 17 for the bears. So the selling pressure hasn't been great. The bears really have, you could say, 2 bars in this stretch, but one of them has a bull body. You can argue 15 as well, closing below its midpoint, but it's really a doji. So as far as selling 19, I would not. Probably more buyers below. 20, we went sideways, and it's an inside bar, so probably sellers above and buyers below. The bear's still hoping. It's 3 pushes up, where the second leg did not go above the first, so 1, 2, 3. And it's also a nested wedge. You can see 3 pushes here, 14, 16, 19. Trying to break out of a bull channel, low probability event. We're pulling back, but there's still not enough selling pressure. There's probably buyers below 20. 21, we triggered the sell, the stop order sell below 20, but disappointing entry bar for the bears. So weak signal bar, weak entry bar. More likely a pullback in a bull channel. Here's the bull channel. As far as buying above 21, it's a high 1, and it's in a bull channel. The problem with 21, it's consecutive dojis, really 3 bars went sideways. It's a trading range, probably sellers above. It's also a trading range bar. It's a high 1, just below resistance. So the upside is probably limited, but the downside is also limited. And since we're in a bull channel, probably going higher before lower. And then we went outside up, 22. Bar 20 was a weak, you can call it a low 1, low 2. It was a weak sell setup. And then 21 was a weak entry bar. So we traded below 21, but all the bears bailed out. We tested the moving average, reversed up strongly. 22 is a bull bar closing on its high. But look to the left, what happened on bar 19. Last time we were here, there were sellers. Since it's a bull channel, bulls are buying below bars and taking profits above bars. So we may go above bar 19, but there's probably sellers above. And then we went outside down 23. So outside pattern, OO pattern, breakout mode. It's an expanding triangle on a lower time frame chart. The market is contracting, small range, breakout, fail, breakout, fail, breakout, fail, breakout, probably will fail. And the context is bad for the bears. It's a bull channel, it's an outside bar at support, the bull trend line, and the moving average. Do you really want to sell below an outside bar? As strong as the bar might seem, because it's an outside down bar, but it's almost similar to what yesterday's bar was on the daily chart. It's an outside down bar, that's great, but it's really a trading range bar, so probably buyers below. 24 is a surprise bar. You're expecting buyers below, instead we had sellers. It's a bull trend line break, but it's the first bar breaking below the trend line. The bears still need follow through. Where are we testing? The bears probably want to get back to the bar 15 high, because we tested it on bar 18 but did not close that gap. Consecutive bear bars, big enough surprise. It'll probably get a second leg down. It's also crossing the moving average and closing below. And we went further on bar 25. 3 consecutive bear bars. So big up, big down, big confusion. The market's in the trading range. So really decent micro channel for the bears. 3 bars down. The odds are the first reversal up will fail, but because it's a trading range, you expect breakouts to have deep pullbacks before a delayed second leg. So if you're a bear, you know you're selling at support. You look to the left, buyers here. Why are there buyers here? Because of the disappointed bears. Bears who were short here got trapped. So what are they doing? They scale in higher. They get out at break even. They're going to look to buy. You also have bulls who missed this rally, and they say this rally was strong enough to get a second leg, so they're going to buy below the rally and look for a second leg. But bulls don't want to buy against 3 consecutive bear bars, and they're fairly decent. There's not much overlap and pretty uniform sized bars. But again, not ideal to sell in this area. Bar 26, a bull bar, probably. It is a combination of bulls and bears buying, but probably mostly bears taking profits. But a big enough bull bar, it's disappointing. And it's a low 1 sell signal bar. So if you sell below bar 26 with a stop, that would be a low 1, but obviously low in a trading range, and a bull bar, not a good trade. A bad stop order is a good limit order trade. You'll have bears looking to get out of shorts below 26. You'll have bulls looking to buy for a scalp. 26 is a trend line break, so on some small time frame, this is a bear trend line break. We're expecting a retest of the lows and then support, a reversal up. Instead, 27, we're going a little higher. We're still within the range of bar 26, so 27 is an inside bar, lowers the probability. Probably buyers below and sellers above. Now 27 is the low 1 signal bar. Bears who sold the close of 25, they got trapped. And that makes the close of bar 25 support. But also, even if a trader sold above 25, they're getting trapped. And that makes the high of bar 25 support as well. And then everybody is giving up on the short and we're going higher. So sell vacuum down, buy vacuum up. It's a good looking micro channel for the bulls, but high in a trading range. Bulls who bought the close of 22, they got trapped. What are they going to do on a retest? They'll probably look to exit. What the bulls have going for them is that it's still a bull channel, so buyers below, and the bears don't have a credible top yet. 29, it's a bad bar if you're a bear. The bulls are getting more and more bars. The bars are closing. The past 3 bars have closed on their highs. And if you're a bear and you sold above any of these bars, 24 or 25, you're getting trapped. And you're going to use any pullback you can get to exit your position. So that creates support below the market. This is strong enough to get a second leg. Is it a third leg up? It might be. Maybe 1, 2, 3. But for me, I think this breakout is strong enough that it might reset the leg count. We have a trading range in here. In the market cycle, we go spike, pullback, channel, evolves into a trading range. We pull back and test the start of the channel, and then we get a new breakout. So this is probably a leg 1 breakout. This is also the strongest breakout of the day. 30 going higher, probably by the close. The context is still bad. Look to the left, you have a trading range day, and you will have some traders seeing this as 3 pushes up. So you might have exhausted bulls who bought down here. They see 3 legs. They might look to sell and not look to buy until after a pullback, maybe 10 bars and 2 legs. The reality, this is a strong enough breakout. There are buyers below, and it should get a second leg up. $31, we're going higher still, but you can see the momentum is slowing. We have smaller and smaller bull bodies since bar 28. Good bull bar, another decent bar, but smaller body, smaller, smaller. On some time frame, it's 3 pushes up, but it's minor. So we went up, pulled back, up, pulled back, up a third time. So on some smaller time frame, it is 3 legs up. You'll have exhausted bulls taking profits. And it's an indication that we are late in the breakout phase. So this is the breakout phase. The market cycle reset. It's leg 1. We're expecting a pullback and then a second leg. But because we're getting late, this is where bulls, it always goes back to the trader's equation. Bulls buy, they buy anywhere for any reason. It's by the close. So let's say they buy here. Their profit target for 1-to-1, stop below the breakout, is all the way up here. And with the momentum slowing down, and with the context, it's not 60% that we go up here before down here. That's the problem with breakouts in trading ranges, and that's why traders prefer to buy pullbacks, like 50% pullbacks. And then we went outside down, 32. So bulls, they get uncomfortable with the risk, and we get 3 pushes up late in the breakout phase, and we find sellers. Now, it's leg 1, and it's a minor 3 legs up. Overall, it's really 1 leg. On this time frame, there's been no pullback. It's been a micro channel from bar 25 to bar 31. So the reality is this is a minor reversal. You expect buyers below, support below. The first reversal down should be minor and not go very far. Remember that outside bars are trading range bars, and it's bad context. Leg 1, outside down, probably buyers below. Might be a big enough surprise for its own second leg. And bar 33 might be that small second leg. Down on 32, pull back on 33, down on 33. 33 is an inside bar. So what we have here is an IOI pattern, inside bar, inside bar, breakout mode. But following a leg 1, probably going to find buyers below and a second leg up. The buyers may not come in until the moving average, maybe even 50% because it is a trading range day. And then we can look at the breakout point as well. If we're looking at bodies, you can see that's exactly where we're testing. And then we bounced on 34. 34, it's a high 1 buy setup. And after a strong leg 1, you're expecting a second leg up. But the problem is high 1s typically fail. Especially in this environment, it might be, I keep redrawing this, 3 legs up, 1, 2, 3. You look to the left, fairly high in a trading range. And then you have this outside bar, and this may not have been enough of a second leg. The reason high 1s fail all the time is, think about it, if you're a bull and you bought the close of 31, it's reasonable to do. You can argue for it. You know that if you buy the close of 31, scale in lower, you're probably going to make money. But then you got 32, and that's disappointing. You're still probably going to make money, and you can buy more lower. But what are you going to do on a retest? That's the problem with high ones. That's why there's usually more sellers above a high one. Most bears don't want to sell above a bar like 34. It's pretty decent after a pretty strong rally. But because of the context, you might have to pause here. And then instead of going above, everybody sold the close of bar 34. 34, it's a strong looking bar for the bears, but it's not especially big. It's a fairly small bar, maybe average size. It's an inside bar, so that lowers the probability for a breakout. And it's a second leg down. 1, 2. After a strong rally, we're expecting a second leg. And that second leg, maybe we get leg 1, leg 2 measured move. That takes us up to around the high of the trading range. That's one possibility. We could pull back further, find support at 50%, but I do think the downside is limited, and the market is still expecting a second leg up after this rally. But it could be a third leg, 1, 2, 3. But I'm not sure 34 was enough. 36, it's a disappointing bar for the bears. We broke out below the inside bar and then reversed up immediately. So it's a high 2 above 36, but again, my concern here is that we might have 3 pushes up, and look at the high 1. Bulls were so disappointed who bought the close of 31. We couldn't even get back to the close before they sold. We tried to get there on 34, pulled back. 36, it's a high 2, but possibly high in a trading range, not in a bull trend. So high 2s at the moving average in bull trends are great trades, but this is not that context. This is a possible third leg up in an overall trading range. And then 37, if you're a bull and you bought above 36, is 37, are you getting excited when you see bar 37? Of course not. It's a disappointing entry bar. There's probably more sellers above, and the bulls will look to buy lower. 38 going more sideways to down. It's another inside bar, probably sellers above, maybe buyers below, but it's a little bit of an endless pullback. We are going more sideways than down right now, and that's good for the bulls. We're staying above the moving average. But at some point, the bulls have to do something. The concern is that the bulls, we rallied up here. This is the second leg. It's fairly disappointing. You have trapped bulls above, and we just continue to go down. 39, we have a bear reversal bar. Maybe one tick breakout below 38. Really not all that strong, but it's a weak buy signal bar. Probably more sellers above, probably going a little more to the downside. 40, bear breakout below the moving average. Now it's looking like an endless pullback. Can you argue 3 legs down? 1, 2, 3. You can. One problem I have with that is the buying pressure. We've had 2 bull bars in the past, maybe almost 10 bars, 8 bars. And every time we had a bull bar, and like I said, it's a little bit of an endless pullback. Bulls never got that second leg, and now this pullback is becoming prolonged. We have about 8 bars down with not much buying pressure. Now we have a breakout below the moving average, 4 bars without a bull body. Some bulls might see 3 legs down. They buy the close of 40. It's a little aggressive, especially when you know the market is more in a trading range. And even if it is a bull channel, so you can argue bull trend line and dueling lines pattern, so 3 legs down to the trend line. But it's a pretty broad channel. It's not a very strong channel. It's not tight. It's more horizontal than up. Look at all the overlap. Think about it. How can I put this? If you bought the close of bar 9 and you sat through all of this, look where you are on bar 40. You're basically back at bar 9. It's not a very strong bull trend. And with the context of yesterday, with what's happening today, 3 legs up, It's really a trading range. So we might have the high of the trading range here, and we're turning down. And everybody knows that if we are in a trading range, gaps are going to close. Where's the gaps? Well, we had the breakout above bar 25. Bears who sold above did something reasonable. Because it's a 3-bar micro channel, this was supposed to get a second leg down. It never did. It's actually really interesting. There's sort of a couple of low probability events. We were expecting buyers below 23, outside, bull trend line, outside down bar, probably buyers below. Instead, we got follow through, so bulls got trapped. You're expecting sellers here. Bulls got trapped, they're disappointed. 3-bar micro channel, we pull back, get a second leg. Then we got this rally. So a couple of surprises. This one is still supposed to get a second leg or some kind of retest. That's where the market might be heading, to test the high of bar 25 where limit order bears got trapped, selling above. Maybe the close as well. Sell the close bears got trapped. If we get there, they'll probably look to exit. But you also have the overall point I'm making is that the market's more likely in a trading range. You don't look at this chart and say, this is an exciting bull trend. You look at this chart and say, yeah, the market's been sideways. It's really just a trading range. And again, gaps close in trading ranges. So that's why I'll draw this one. Change the color to blue. 41, we came close to the high of 25 and bounced. Not surprising, the market will often come close to a magnet and then reverse, only to come back to it just a little later. So actually, with bar 41, it's a bull reversal bar, but it's completely below the moving average after 4 bars without a bull body. Pretty tight bear channel. This could all be seen as one leg, and then we get a pullback, second leg down, testing lower prices. It's a bad buy setup, and therefore it's a good limit order sell setup. We came so close to this magnet, we're probably going to get there. 42, traders sold the close. Instead of getting the high 1 to trigger, you can argue high 2. You can even argue it's a high 3 because we triggered above 33, 36, and then this would have been a high 3. Bear trend bar, but an inside bar just above support might be a limited downside, but the buying pressure is pretty weak. There's not much for the bulls going here, so pretty tight bear channel. I apologize for the background noise. Probably going a little lower. So bar 43, we finally tested that magnet and found buyers through support because of the trapped bears. The bulls, they see a buy setup above 43. It's a good signal bar, but again, where's the buying pressure? You're actually buying in a place where there's probably more sellers, and the market's still probably going lower. And you can see we triggered the buy above 43, and disappointing bar for the bulls. It's a bear bar. It's a low 1 short at support, so not ideal, but if you had to choose something here, probably always in short, going lower. But not ideal. The market's really more sideways, and when it's confusing, it's best to wait. You have a big triangle. The market's getting squeezed. And you can see we're touching close to this line, maybe here, and it's support, and then up here, resistance, and the market is getting tighter and tighter into a tighter range. At some point, the market will break out, but 50% of breakouts of triangles are in the wrong direction, the first direction it goes. And because of the tight trading range we've had all day, I'm not expecting some major breakout and trend into the close for the day. 45, low 1 below 40, low 1 short below 45. Probably more buyers below and support below. It's a weak signal bar, but there's no buy setup as well, so we might have to go lower to find buyers. There might be buyers below bar 43. And if there were, they got trapped on bar 46. Big bear bar, but it's the biggest bear bar in all of the bear bars in this sell-off. And to me, that's fairly climactic. This is a bar where, if anything, I would look to take profits if I was short. That's the problem with selling a bar like 46. 47, we had follow through. If you were short and you get bar 46 and you take profits on 40, you're short anywhere in here, you take profits on the close of 46. It's not a big deal that this got follow through. You're selling a climactic bar at the bottom of a trading range. So the downside's probably limited. We might be testing the low of yesterday once again, and if we do get there, we're expecting support. 48's a bull bar, profit taking from the bears. But again, because this is climactic, there's an increased chance that we reverse up here. We fell below this micro channel, and there were probably buyers below it. And that's a problem for the bears as well. They're starting to buy here. 48, low one, probably buyers below. 49 tried to break out and failed immediately, coming close to the low of yesterday once again. But just look at this chart, and it goes back to this, what I was saying in the beginning. The market is in a trading range, and look where we are. This is the start of the lower third. So this is the buy zone. Anywhere in here, traders will start to buy. That's the danger with selling or being short down here. 49 is a bad stop order signal bar for the bulls. Probably more sellers above, but the context is bad to be selling. 50, we broke below yesterday's low and reversed up. It's still a pretty tight bear channel, but the context, again, it always goes back to context. Tight bear channel, but look to the left. It's a trading range, and we're getting low in the trading range. Now we're getting a second reversal up. Technically a first reversal. We didn't trigger above bar 48, but 49, or bar 50 rather, is a bull reversal bar closing on its high, failing to break out below support, and again, low in the trading range. So with a bar like 50, bears will exit above 50, and bulls will take a chance with stop order buy above 50, looking for a swing low, and then we rally to the top of the range. 51's a weak entry bar for stop order bulls, but always think about the reverse side of the coin. 51's a low one short setup at support, probably buyers below. 52, we did not go below, but traders bought the close of 51, and now we have a bull bar, 52. Now we have a second reversal, technically, and bulls will buy above 52, bears will buy above 52, buying back shorts. We're low in the range, tight trading range, barbed wire, really. So not ideal to be trading with stop orders, but because you're low in the overall range, it's okay to buy here, look for a move up. 53, bull breakout, a little bit of a surprise, but consecutive bull bars, one being fairly big and closing on its high, closing above the moving average, probably always in long, probably a leg one, reset the market cycle, maybe 3 legs down, sell climax, tight trading range, final flag, and then we get the upside breakout. There might be buyers. There are probably buyers below 53, but as far as on the close of 53, the context isn't great. And the reason for that, there's a couple of reasons. One, you had bulls buying below 43. They got trapped, so there's resistance in this area. You can actually see the market broke straight through that. So that's a warning that we may not stop here. But you also had, it's a big bar in an overall trading range. Whenever there's a big bar in a trading range, you expect profit taking. 54, big reversal. It's a 2-bar reversal, but 54, it's a variation of a low one short, low in a trading range, and a strong enough breakout 52, 53 that you're probably going to find buyers below. Also, remember what I mentioned, 52, 53, probably always in long, but we're in a trading range, and always in is opposite in trading ranges. That's the problem with big bars like 53 at resistance. So big bar 54, but it's the same exact problem as 53. There's probably buyers below 54. 55, we went a little lower, and it's a small bar, so If this is a strong bear reversal and a strong bear breakout on 54, why didn't 55 form a bar like 54 and close down here? There's a problem with it. It's suspicious. So we triggered the low one, but it's fairly disappointing. We're back into the tight trading range, low in the overall range, probably buyers below. Outside up 56, bull bar closing on its high. Now we have a more credible bottom for the bulls. This tight trading range is a problem because tight trading ranges, it's barbed wire, and let me go back and show it like this. Tight trading ranges represent a fair price. You think about the purpose of markets. The market's purpose is to facilitate trading. They want the maximum number of buyers and sellers at any given time. When the price is wrong, we have to find the fair price. And the market's always probing. Is it higher? Is it lower? Where's the fair price? Well, you can see here, the market is sideways for many bars. This is a fair price. And 80% of breakouts of trading ranges fail. We get a breakout of a tight trading range where this is a fair price. The odds are it'll fail. But we try to go the opposite way. It'll also probably fail. Now the problem with 56, this is where always in bears have to exit. And bulls will buy above 56. And here's why it's a better setup. Acceleration and then sideways, spike and channel. Trading range, the market cycle reset. We're trying to break out below and failing. Now we have a double bottom. It's not the greatest. I can draw it like this. You can see we're still on the bear trend line, which isn't ideal. But if you think about it from this perspective, new bear breakout and channel, this is clearly a trend line break. Maybe the channel and the trend line is like this. Clearly a trend line break on 53. Pullback, low one short, buyers below. It's a variation on a smaller time frame. It's like a major trend reversal setup. And of course, think about the context. Look to the left. We're right above support, the low of yesterday. And look to the left, low in a trading range. 57, it's not the gold standard entry bar for bulls, but it's also not bad. The bulls prevented a bear bar, and 57 is a bad short. Probably buyers below, and bulls are probably holding. We go higher on 58, there's a tick gap, and there's actually no tail below the bar. That's actually fairly rare to see, open tick gaps like that. So the close of 57 is one tick below the open of 58. So bulls, as soon as 57 closed, they bought the market. Everybody bought, and the market had to go up a tick, and we continued higher. Crossing the moving average, possibly two legs up, 53, deep pullback, 58. But where's the bear setup? Are bears selling below 58? Probably not. It's a weak sell signal bar. It's a bull bar, 3 consecutive bull bars. The context still supports higher prices. So the bears will sell if we get a good signal bar, but that's if we get a good signal bar. Is 59 a good signal bar? Of course not. It's a doji. The micro channel is continuing, probably buyers below, and a second leg up. 60, we're going even higher. The micro channel continuing even more bars. 5 consecutive bars with lows above the prior low. Good for the bulls. Context is still pretty bad because we're in the middle of a trading range. So at some point, once again, I'll draw this. Can't draw it enough. Here's our trading range. You buy in the lower third, you take profits in the middle third, and guess where we are? We're actually getting closer to the upper third. We're in the lower portion of the upper third. So this is where bulls will look to take profits. And there's additional reasons to take profits. Leg 1 on 53, leg 2. There's tails on these bars, overlap. There's increased sideways trading, two-sided trading, probably sellers. We're also testing the sell climax, 46. And this is going to be an area of resistance as well. 61 bear bar, but the first pullback in a micro channel. And stalling at the moving average. High 1 buy above 61, so probably sellers above. And then, as always, I say that it's so common to see it. You see these high ones that just don't trigger. there's probably limit order sellers above, but at some point they decide my limit order isn't getting filled. There's a sense of urgency. I gotta just sell the market, and we go lower. So there's a small pullback, but basically traders sold to close and maybe a 1 or 2 tick pullback, and we went lower. 62 is a disappointment for the bulls. It's a trend line break, and it's the high 1 buy setup signal bar. Sellers above 62. And then 63, it's an inside bar, reduces the probability for breakouts in either direction. Probably sellers above 63. There might be buyers below, but there's still room to the downside. This was also strong enough for a second leg, and we're still expecting that. And then not outside down, but we triggered above 63 and reversed immediately. But now 64 is a low 1 at support. We had bears selling above 55, betting bear breakout and follow through, 54, 55. So they sell above 55. They get trapped on this rally. You can see we retested it and bounced, tested it, bounced. The bears are trying a third time, but it's a low 1 at support. And then we tested a third time and find buyers once again. 65, it's not the strongest signal bar, but it is a buy reversal bar, but it's a doji, so not ideal. But 2 reversals up above 63. Bulls might buy above 65, looking for a test of the close of 60. This should have had a second leg. 66, going higher. Now, this was a micro channel, and we had bulls buying below 60. I didn't mention it, but it already did test it on 64. So they're trapped here. We get the high 1, 63, but trapped bulls. We test it, we reverse down. We're going to try to test it again after 66, but this might be more of a resistance area. You can see the market's in a tight trading range. 67, buy vacuum, going higher in the range, maybe testing the close of bar 60. But I say buy vacuum because it's high in a trading range, and it might be 3 legs up. 1, 2, 3. 68 tried to break out to the upside, but it's 3 legs up in a trading range. And we're testing the upper third. If you remember, this was roughly where the upper third of this range starts. We try to get up there, and everybody sells. 3 legs up, and then a sell signal bar, 68. But it's a fairly big bar, so fairly big risk. Not ideal. This might get a small second leg before bears look to sell. And then 69 is that small second leg. So we rallied all the way up to 68, pulled back, rallied on 69, and then pulled back again. So that's 2 legs up on a smaller time frame chart within a third leg. So probably sellers above 69. Inside bar reduces the probability for breakouts, sellers above, buyers below, but I would not buy below in this context. Inside bar 70, so inside pattern, breakout mode. The first breakout, 50% chance it fails. If we go above, there's likely sellers, and then we may fall to the downside. 3 legs up, 1, 2, 3. The second leg, or the third leg rather, subdivided into 2 legs. So this is a problem for the bulls. We got the bear breakout attempt below 70 and then reversed up. So bull bar 71, bull reversal bar closing on its high, but bad context. It's a good looking candle, if you look at the 1 bar itself, but you zoom out and look at the overall context. The odds are there are sellers above. And everybody sold the close on 72, the close of 71 on 72. Bear bar, disappointing. After 3 legs up, might be the start of a first leg to the downside. Probably sellers above 72, maybe even on the close, maybe a 50% pullback of the bar. Probably going lower, but really sideways, probably more sideways into the close. 73 pulling back, but roughly 50% pullback of the bar. And the bulls are proving that there's resistance here. They're not buying here, they're taking profits. And the bears, they're accumulating selling pressure. There's probably more sellers above 73. Bull breakout attempt, but of course, sellers above. Testing The channel line, low probability, low chance the bulls get the breakout. Bulls are buying below bars, taking profits above bars. 74 is not the greatest sell signal bar, consecutive bull closes, but the context really supports it. The better trade is limit orders, selling above bars. So 75, we fell below 74, but it's a weak setup. You look at these bars, it's a really tight trading range, and you've had two bear bars. You can argue 69, but bull bodies on these bars for 5 out of 7 bars. Fairly weak double top, maybe a wedge top, but lots of overlap. Tight trading range, buyers below bars, sellers above bars. 75 is a high one, but probably sellers above. And then 76, another instance where there's probably sellers above, limit orders don't get filled, and everybody's forced to start selling the market. Decent looking bear bar, 76, but might be 2 legs down, 1, pullback, 2. Where are we testing? We're testing a bad signal bar for the bulls, so bears who sold above bar 65, they got trapped on this rally. We're retesting it once, retesting it twice. Might be support there. Surprise bar, 77. It's really an emotional bar. That's what Brad calls them. They're these big breakout bars, but they're occurring inside of trading ranges. So yeah, it's an impressive big bar, but there's big tails. It's an outside bar, so really it's an expanding triangle. And we can see the expanding triangle on this time frame. And I'll draw it. 2 or 3 legs down, 2 or 3 legs up. Really breakout mode. Breakouts are failing. Probably more sellers on the close of 77 than buyers. 78, that's what happened. We're testing the 60-minute EMA. We're testing high in the range. Breakout points to the left. Pick any of them. Buyers at the moving average here. They got trapped. Look to the right where we're retesting. And then maybe it's 3 or 4 legs up. A couple of reasons to look to sell in this area. Despite the big looking bar, it's really just to sell, really just a buy vacuum of resistance, and traders will sell the close of that bar. 78, a big bar, but again, low in the expanding triangle, similar to 77, probably buyers below, and sideways into the close. In 79, that's what happened. We tried to break out below, but low in a trading range, expanding triangle, breakouts are failing. We're within the range of these bars. It's mostly sideways, probably sellers above 79, more sideways. Bull breakout attempt, but failed. Consecutive bull bars, probably buyers below 80 and sellers above. And then we bounced, went a little higher, testing the close of 77 on bar 81. This might have been enough of a surprise for a second leg, and that's what happened. For always in today, I talk about always in. It's really a trend following concept. So we had trading range price action into the close of yesterday. We had trading range into today. So where is it always in? Well, it's always opposite when you think of always in trading ranges. Better to think buy low, sell high, scalp. So I think I mentioned somewhere that it was always in. I think it was here. Consecutive bull bars, crossing the moving average, but just barely, and look to the left. When it's always in long in a trading range, it's time to look to sell. Over here, decent looking rally, but might be 3 legs up. Time to look to sell. And it goes for every single move. 3 bear bars, looks like a pretty decent micro channel. Look to the left. Support in a trading range, always in short, means look to buy. Stop order trades today. I thought it was reasonable to buy above bar 6, and then it's always tough on trading range days. It's more of a limit order market. The next best stop order trade, maybe you sell below 35, second reversal, tried to reverse here, pulled back, second reversal after 3 legs up, high in a trading range, take a chance, we get a swing trade. Same with 39. You can sell below it, taking a chance that we're high in a range with an open gap. 52, it might be reasonable for a scalp. You have maybe 3 pushes down, but it's minor, but you are low in the range. But traders are looking to scalp out at the moving average. So we get there, go a little beyond, they take profits. We come back, and then we get this bar 56. I mentioned always in bears at that point have to get out above 56, which means bulls will buy above 56, and we get a rally. And then what happens? You get a pullback back to your break even before long. And that's about it for stop orders. Limit order trades. Look at the context. We have a gap down trading range. I mentioned buying above bar 1 was a bad trade for stop orders, which makes it a good limit order trade. Sellers above bar 1. I thought there were buyers below bar 1, but they may not come in until the low of yesterday. And then so maybe, let's look back in real time. 3, it's a bigger bar than bulls would have liked, but they can scale in lower and avoid a loss. High 1, but tight channel, sellers above. And then low 1, buyers below, but doesn't trigger. Buyers below these bars, they never triggered. Bar 9, remember I mentioned bar 9 was climactic, and the 4th bar in the micro channel, really the maybe 6th bar, but the 4th consecutive bull bar, and it's most climactic at the moving average, right where bulls got trapped on bar 1. Some traders will sell bar 9. It's aggressive, but it makes sense. 2 legs down, leg 1, pause, buyers below bar 12, expecting a second leg. Weak reversal attempt 17, probably buyers below. High 1 above 21, high in a trading range, never a good trade, sellers above. Probably sellers above 25, 24, not the greatest context because we're at support and we're in a trading range, but it was reasonable to do. I think the more ideal limit order trade here, you get this breakout, you know it's strong enough for a second leg, but you also know that second legs are delayed in trading ranges. So bears will sell above the start of the breakout up here, and they did on bar 29, but they were disappointed by their entry bar, and then 30 let them out. 33 is a bad high 1. It's a decent rally, but it's a bad high 1 signal bar, and it might be leg 3. And then you get sellers above. 36, I was concerned about that high 2 as well because it's high in a trading range. So not a bull trend, high 2, you can sell above it. Micro channel down here, so 43, unlikely to be the major reversal point, sellers above, and then sellers above 44 as well. Low 1 short below 48, low in a trading range, bull signal bar, buyers below, they scale in lower. Tight trading range in here, sellers above bars, buyers below bars. We get the bull breakout, but it's minor. No follow through, bears were sold above, scaled in higher, they made money. I thought 55, the bears needed more. 54 is a good bar, but bad context. We're in the middle of a tight trading range, and then 55 disappointed them, so everybody bought, buyers below 55. Rally up to here, we had a doji, but 2 legs up, look to the left, resistance, high in a trading range, sellers above the trading range bar on 60. And then all in here, really, tight trading range, limit order market, buyers below bars, sellers above, but you're not going to sell above here because the top of the trading range could be all the way up here. So it's not an ideal buy, but what bears will do, rather than sell here, maybe they'll sell above this bar, scale in higher. Two legs up for the bulls, double top, sellers above. They don't come in until above 73. They don't get triggered until 74. And then in here, it's sell the close, 77, buy the close, 78. As far as next week, where do we go Monday? Well, the market is in a tight trading range. And we just look at the past couple of days. It's a lot of sideways price action. And I suspect the sideways trading will continue. Look at the daily chart. It's a high one above today's current bar, but possible parabolic wedge. 1, 2, 3. High one, but late in the breakout. We're expecting a pullback because it's a parabolic wedge. You have exhausted bulls, maybe 2 legs up. So probably sellers above today's high, but the downside could be limited. But we could pull back maybe, let's see. We can start by looking at breakout points like this bar, which is about a 50% pullback. So for a couple of reasons, we could vacuum down to that price level, which is this red line. You can see 50% of this rally is just about this breakout point. But are we going to do that on Monday? Probably not. But the upside might be limited. As always, please feel free to leave questions in the comments and include timestamps for any questions specific to this video. And with that, I hope everybody has a good rest of their night. Thanks for watching.